Hello all, good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on emerging global challenges and way forward. We sincerely appreciate you taking the time out to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Thilan Wijesinghe, Chairman and Managing Director at TWC Holdings Private Limited. Mr. Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Ms. Tanu Goyal, Senior Fellow at ICRIER India. Ms. Sanusha Naidu, Senior Research Associate, Author, Foreign Policy Expert and Political Analyst at UNISA, Nelson Mandela School. And Mr. Yeshi Lendu, Senior Analyst at Ministry of Finance, Bhutan. This session will be moderated by Rajani Sinha, Chief Economist at CareEdge Ratings. We will commence the session with the presentation by Akanksha Bhende, Economist at CareEdge Ratings, and Annie Mahajan, Economist at CareEdge Global. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries at the end of the discussion. Now, may I invite Akanksha to make the presentation.
Thank you so much, Mamta. A very warm welcome to our webinar on emerging global challenges and way forward. As global economic headwinds evolve and intensify, today's webinar is aimed at understanding the evolving global trade scenario in a world that's marked by rising uncertainty and fragmentation. Against this backdrop, we also take a look at what the weakening trend of the US dollar could mean. And finally, the presentation will also cover the aspect of rising sovereign debt burden, a trend that is shaped by both the ongoing trade disruptions and rising fiscal pressures. After decades of rising interconnectedness between economies, a period termed as hyperglobalization, the period post the global financial crisis has witnessed a shift in the dynamics to what many refer to as globalization. This term refers to a world where global trade is stalling, global value chains are maturing, and cross-border investment flows are losing momentum. This marks a slowdown in the global economic integration that had powered growth for decades. As the slide shows, exports of goods and services as a percentage of GDP have plateaued since 2012. If we look back, global exports grew strongly between 1995 and 2008, clocking a CAGR of around 9%. But post-2008, that momentum has clearly slowed, with growth moderating to just about 3%. Another key point is that the flattening global exports is largely driven by merchandise exports, while services exports have remained largely resilient. Turning to the outlook for global trade, we see that protectionist policies are on a rise globally, with tariff measures being announced by the US and countermeasures being announced by its trading partners. In the current scenario, tariff wars are no longer isolated events, and the global environment remains highly unpredictable. Reflecting these challenging conditions, the IMF has cut its global export growth projections, lowering the 2025 forecast by 2 percentage points and 2026 forecast by 1 percentage point. In today's landscape, the sudden imposition of tariffs and retaliatory responses are intensifying trade costs and shaking the foundations of global supply chains. While this adversely impacts all economies, the repercussions are likely to be far deeper for economies heavily dependent on exports and closely intertwined with US and China. In this context, it is critical to see how several economies are placed in the global trade landscape to face the risks from US tariff pressures and a potential economic slowdown in China. As seen in the slide, economies such as Vietnam, Malaysia, and Thailand not just have a high share of merchandise exports in their GDP, but also have high export exposure to US and China, more than 20% of their GDP. The other noteworthy aspect is that both Canada and Mexico have strong export linkages with US and China, making them directly vulnerable to risks. Coming to the growth scenario, global growth in the recent years had already come under pressure on account of persistent shocks from COVID-19 pandemic and rising geopolitical tensions. The growth outlook has been further dampened by the ongoing tariff restrictions. While this is expected to adversely impact the growth across economies, the export-oriented economies are likely to experience a pronounced slowdown in economic growth over the next 5 years as global trade dynamics weaken. Beyond the impact on growth performance, tariff uncertainty also poses significant risks to external stability of these export-oriented economies, particularly through pressures on their current account balances. The current account balances of export-oriented economies are projected to worsen during the next 5 years, with notable moderation likely in case of Thailand, Germany, and Malaysia. Global foreign direct investment flows, which is another critical pillar of globalization, has also come under pressure. The global financial crisis had a lasting negative impact on the cross-border investment flows. Later, a series of adverse events, such as the 2018 US-China trade tensions, the global pandemic, and Russia-Ukraine conflict, resulted in supply chain disruptions, fueled global inflation, and triggered tighter global financial conditions. As a result, the global net FDI inflows as a share of global GDP have shown a declining trend in the post-financial crisis era. Historical evidence suggests that global FDI flows have shown a strong positive association with international trade. On the contrary, rising fragmentation has also been strongly associated with decline in global FDI flows. Given that the current global landscape is characterized by trade-related uncertainties, FDI flows are expected to remain weak going forward. An analysis of FDI flows to GDP of the major economic players shows a declining trend of FDI inflows and outflows to US, China, and the European Union. Some economies have gained from such reorientation of FDI flows. Typical gainers of this reorientation have been the connector economies. These are economies which have a favorable mix of FDI policies and structural characteristics. They have managed to capitalize on the trade and investment reorientation strategies of China and US to drive up FDI inflows from one or both of these countries in the recent years. Let us now turn to another key development shaping the global economic landscape this year, which is the weakening trend in US dollar. Since January, the dollar index has depreciated by nearly 10%. This marks one of the steepest first-half declines since 1973, following the dissolution of the Bretton Woods system. Consequently, many other currencies have appreciated over the same period. The broad strengthening trend seen in other currencies has critical implications for their export competitiveness and capital flows. These trends remain a key monitorable going forward. Another notable global trend is the diversification of foreign exchange reserves. While the US dollar continues to remain the world's leading reserve currency, its share in the global foreign exchange reserves has been declining as central banks actively rebalance their portfolios. This has been accompanied by an increase in the share of some other currencies, such as the Australian dollar and Chinese yuan. Furthermore, the increased demand for gold by central banks signal their intent to hedge, not just against inflation or volatility, but against systemic risks in the global currency reserve system. I now request Annie to proceed with the presentation.
Thanks, Akanksha. Now, let us look at the rising sovereign debt burden, a trend that is shaped both by rising fiscal pressures and ongoing trade disruptions. Looking at how the government debt levels have evolved, we can see that there was a sharp surge in global debt levels post-pandemic, which was driven by large fiscal stimulus, social spending, and extensive government subsidies to revive private consumption. This fiscal expansion was followed by course correction by many economies, leading to a brief period of moderation in debt levels. However, with global monetary tightening and rising borrowing costs, debt burden started increasing again. Now, the debt levels are expected to climb back to around 100% by the end of this decade, back to pandemic levels. What makes this even more concerning is that the accumulation of debt coincides with a period of moderate global growth prospects, given the trade-related uncertainties. This widening gap increases concerns over the debt sustainability. While the rise in sovereign debt is broad-based, its nature and implications vary across economies. Advanced economies, which already account for a significant share of global debt, continues to see higher debt ratio and are projected to return to their pandemic peaks over the next few years. On the other hand, emerging and developing economies, which though started with lower debt bases, have experienced rapid debt accumulation post-pandemic. But here, debt accumulation alone is not the problem. It is compounded by narrowing growth interest differential. This growth interest differential, or R minus G, is a key indicator to assess debt sustainability, where positive ratio means that the higher growth is able to manage the interest burden, thus keeping debt at manageable levels. We can see that this growth interest differential is expected to narrow across advanced and emerging markets. Considering that the debt levels for these economies already remain high, it warrants caution. However, interestingly, the differential is expected to improve for low-income economies, mainly due to its growth revival. Yet, it will be important to see how these economies will be able to sustain growth. A deeper look at the advanced economies reveals that these economies face a more difficult fiscal landscape. Debt affordability, which was once a shield, is showing signs of weakening trend due to higher borrowing costs, as reflected by rising yields across advanced economies. These yields are expected to stay higher for longer than expected. And if we look at the graph on the right, the gap between primary balance and the overall fiscal balance, which indicates the interest burden on the economies, is also expected to widen going forward. Further, as the fiscal deficits for advanced economies widen, these economies would face fewer policy choices, considering that these economies already face the structural burden from unfavorable demographics along with imminent rise in defense spending. A cross-country analysis for advanced economies with respect to their growth interest differential reveals that this differential could squeeze and even move to negative territory for most of the economies, assuming that the interest rate remains at the current elevated levels. Now, this narrowing differential becomes even more concerning for the economies where primary deficits are expected to widen going forward. Considering the fact that these economies, including France, UK, and US, which continue to hold high debt levels, debt sustainability could be a challenge, especially in the absence of debt affordability buffers. Now, looking at the debt landscape for emerging and developing economies, we see that the debt levels for most of the economies remain at stable or manageable levels, except for China, which remains an outlier due to its sharp surge in debt trajectory. For other developing Asian economies, excluding China, and even for Latin American economies, we see that the debt levels had peaked up during the pandemic and are expected to stay at the elevated levels. Whereas for sub-Saharan economies, we saw that there were a series of measures, austerity measures, and reforms which have managed to keep the debt levels at moderate levels. However, for these economies, debt levels are not really the challenge, but debt affordability is, which can be seen on the next slide. Here, if we look at the left graph, interest as a percentage of revenue has been higher for most of the emerging economies and continues to increase gradually. And further, in the scenario of higher borrowing costs, these economies are likely to face even higher interest burden. This would mean that these economies, which already need quality expenditure, would further witness further squeezing in the fiscal space. Additionally, due to their lower domestic market penetration, these economies have higher reliance on external debt. The extent of pressure can be seen that the average interest paid on the external borrowings by developing economies is nearly 3 times that of advanced economies. In this context, rising external debt servicing burden could put further pressure on refinancing. So, to conclude, we can say that tariff-related uncertainty is expected to weigh on the global performance of growth, exports, and capital flows. In terms of currency developments, while there is a trend of USD weakening and diversification in global reserves, USD remains a dominant reserve currency. And in terms of the debt landscape, while the debt expected to remain at elevated levels, slowing growth across economies poses a challenge to debt sustainability. In addition, rising cost of debt remains a key monitorable in the volatile environment. Thank you. Now I hand it over to Mamta.
Thank you, Akanksha and Annie. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Rajani Sinha to take over the session, please? Rajni has over 2 decades of experience in the field of macroeconomic research. Before joining CareEdge Ratings, she was the chief economist and head of research at Knight Frank. She has also worked with top institutions such as Aditya Birla Group, Kotak Bank, and JM Morgan Stanley. Actively devoted to demystifying this financial world, she regularly writes opinion pieces for business dailies on varied economic issues and occasionally delivers lectures at educational institutions. She is an alumna of the Delhi School of Economics and Lady Sri Ram College. Over to you, Rajni.
Thank you, Mamta. So, like our presentation showed, we are indeed going through very turbulent times. So, if we look at global trade that had been harbinger of global growth for last few decades, has been moderating. You look at the currency market, US dollar, which was always considered the safe haven currency, is weakening even in midst of global uncertainties. Global debt, the other issue that we spoke about, that shot up sharply during the pandemic, continues to grow. And this is especially concerning at a time when global growth is slowing and interest cost remains relatively high. So we are going to discuss all this in detail. And I'm very happy that we have a very dynamic and diverse set of experts with us to discuss this. And I'll quickly introduce them before we move into the discussion. So we have with us Mr. Thilan Wijesinghe. Thilan is currently Chairman and CEO of PwC Holdings, an investment banking and advisory group he founded 13 years ago. He sits on boards of several public and private companies in Sri Lanka, India, and Maldives. He has degrees in industrial engineering, economics, and business from State University of New York and Cornell University. Thilan is an entrepreneur and angel investor. So thank you so much, Thilan, for joining us. Mr. Deepak Mehra. Deepak is the chief economist at Commercial Bank of Dubai. In his career spanning over 3 decades, Deepak has held leadership positions in banks like Citibank and Credit Suisse. He's an alumnus of Indian Institute of Technology and has an MBA degree from IMT. A regular speaker at conferences and on television, he's also the author of 2 successful books, Ready, Steady, Go, and Think Like a Golfer. Welcome, Deepak. Ms. Tanu Goyal. Tanu is a senior fellow at ICRIER. She has worked extensively on diverse set of issues relevant to India's domestic and international policy discourse, including MSMEs, G20 priority areas, and architectural elements of FTAs. She has co-authored a book on India's special economic zones and co-edited a book on India-European free trade agreements. Welcome, Tanu. Ms. Sanusha Naidu. Sanusha is a political analyst and foreign policy expert in Cape Town. She is an associate at the Nelson Mandela School of Public Governance and a senior research fellow at the Institute for Global Dialogue at UNISA. Her work centers on African democratization, political economy, and South Africa's foreign policy. Sanusha holds a master's in international relations from the University of Staffordshire. I think I'm not sure if Mr. Yeshi Lendup has been able to join us. Mamta, has he joined us? So I'll just very quickly introduce him, and if he's able to join in between, then we'll go ahead. Yeshi is a senior analyst at the Department of Macro, Fiscal and Development Finance within Bhutan's Ministry of Finance, where he plays a crucial role in public debt management and climate finance. With a master's degree in public policy focusing on economic policy analysis from the University of Tokyo and extensive experience in both national and international financial environment, Mr. Lendup is a key figure in Bhutan's economic strategy and sustainability efforts. So, thanks a lot to all our esteemed panelists for joining us and taking out time for this discussion. So, I think I'll start with you, Tanu. So, reciprocal tariff is the most topical issue at this point in time. And what we have seen is that US has announced different reciprocal tariff rates for different economies. They have got into these trade agreements, again, bilateral trade agreements with different economies that different with different conditions. So it looks like bilateral trade is the flavor now. So even if you look at India, India has got into an FTA with the UK, and there are some more in the offing. So in the given backdrop, how do you see multilateral trade relations evolving globally?
Thank you, Rajni, for this question. And first of all, let me thank CareEdge for having me here today. The pitch presentation was really good. It was all encompassing, and I think you've touched on all the right issues. But as somebody who's worked extensively on trade, I think it's also a very pertinent question that you ask. But rather than, dwelling on, what is the implication of these for multilateralism, I think what is more important is for us to step back and ask ourselves why our economy is adopting these inward looking policies. And the answer to that lies in the dilution of their faith in multilateral trading system. I started working about 2 decades ago, and I realized that we are still talking about this. It's not a new issue. Ever since I started working on trade, I've always heard terms like deadlock, stalemate, failure, which is associated with multilateral institutions. So there's something which is not right since a very long time. Whether it was the Doha round, whether it was the services discussion, the dispute settlement mechanism, which is a more recent problem which has happened, and which has also been the cornerstone of the WTO, which is now more or less adjunct in some ways. The unilateral tariff more recently, which are being called reciprocal tariffs, including those on digital products. This is completely against some of the fundamental principles that were laid out by the institutions, especially the WTO. It is the classic battle, if you look at it, between big versus small. And the problem now is intensified because smaller nations and some of the emerging market economies have become mightier. And most of these are driven by hegemons that were in the past champions of multilateralism. So this clearly puts, now when you look at it from a developing country perspective, especially, emerging market economies and even LDCs for that matter, this has completely put us in a disadvantageous position as our participation in some of these institutions, even our decision to liberalize domestically, it was founded in trust on some of the rule-based trading systems that were established in mid 90s. And these recent measures adopted by the developed countries, they create an uncertain environment about the future of multilateral trading regime. And it is actually now, if you see what's happening, it's actually resulting in fragmentation within the WTO itself. We are seeing a lot of it now. So there's a rise of informal groupings on topics which go beyond traditional tariff and non-tariff issues. And we see these signals where multilateral forums themselves are converting into mini-lateral arrangements. JSIs are the classical example. So a lot of the conversations are now actually taking place in informal groupings, and some odd groupings are coming together to have some sort of initiatives and joint statements on some of these subjects. So that's one thing that's happening as an outcome of these inward looking policies. The other thing, and as you rightly said, is a sudden rise in preferential arrangements that is happening. So as of date, if you look at the database, which is released by the WTO itself, there are about 376 odd regional trade agreements which are in force at this moment. And a lot of these, more than probably 100 of these RTAs, have come in force in only the last 1 decade. So it's time that multilateral institutions not only, they have to reinvent themselves,
But there's also a need to reform, because if you see the way their trajectory has evolved, earlier there was a deadlock on specific topics, but now the basic premises are being questioned. I think it's time to address some of these emerging realities and reforming the multilateral institutions by themselves. Let me stop here in the interest of time on this topic.
Yeah, so yeah, thank you, Tanu, for that perspective. You're very right. Now the realities are different, and there's increased focus on these bilateral trade agreements, and the whole multilateralism has come under a question mark. Now, with that, Deepak, I would like to pose to you this question as to, in this scenario, with whatever is happening on the reciprocal tariff front, there's a lot of uncertainties. The details are still emerging. But broadly, in midst of all this uncertainty that we are seeing, what are the economies that are better prepared to cope with this in terms of their competitiveness or any other kind of preparedness? Which are the economies that you would say are better prepared to handle this?
That's a very good question, and thank you very much for the background given in your presentation and from Tanu just now. The short answer to your question is very few countries. I would have said none, but very, very few countries are going to benefit, if at all. This is US reasserting its global dominance. It has been shaken in the last 25 years by a second global power emerging, as in China. This was unexpected. Since the collapse of USSR, it was a single unipolar world dominated by the US. US, in fact, worked to bring China into the folds of WTO and, in effect, gave China the platform. China, in fact, was not expected to do as well as it has done and emerged as a massive competition to the US. And it's now the US trying to reassert itself, trying to reestablish the unipolar, the uni-hegemon, the single power, superpower world order. And that is exactly what is happening. None of the countries are going to benefit from this. This is US trying to make itself great again, but very clearly at the expense of every other country. This is not just US making itself great, it is at the expense of every other country, which, by the way, all of us, including India and every other country, benefited tremendously because of the peace that the unipolar world got with a single superpower starting from 1991. The emergence of India or the emerging markets from then on is thanks to that phenomena. It is not something magical that we did. We benefited tremendously from the outsourcing that the US pushed out, the work that the US pushed out to all of us and made the world more prosperous. I think it is time for now US to extract its own pound of flesh. Nothing wrong in that. So very difficult to say if anyone really benefits from this. Short answer to your question. Now, there are some countries which will be hurt much more. And that is, if you look at their US exports to GDP ratio, then Vietnam, for example, has 30% of its GDP exposed to US exports alone. So you can imagine how badly it will be hurt. Or Mexico, 27% of its GDP is US exports. Or South Korea, 6%. So on that metric, India is only 1.1% exposed to the US exports. So we can say that India is possibly better positioned than many other countries, including better positioned than EU, where Germany has some 3.84% of its GDP exposed to the US exports. So India is very well positioned, given the low exposure to US exports. But also India has another advantage that we are not an export-oriented country, unlike many other emerging markets that thrive only on exports. We have a 1.4 billion population, and we are a domestically consuming economy. Luckily, our governments, successive governments, have not taken on the debt that China has taken on, trying to develop its country, trying to get aggressive growth levels. And luckily, we haven't gone that path, which is the investments and export subsidy oriented growth. We have developed gradually, slowly, but a more resilient growth, which we can now benefit from. Our only challenge is that when we have this trade negotiation with the US, possibly one of the most difficult things for the current government, US is not just worried about putting tariffs on what India is exporting to the US. US is also looking at India as a massive market of 1.4 billion people. And it wants India to open it up for US companies. Remember, China is closed. And Chinese consumers don't consume the way Indian consumers do, even though their per capita GDP is much higher. So US wants India to remove the tariffs that India has imposed on US goods. And the tariffs are huge, like 60, 70% on an average. And I think that's where the challenge lies for us. But I'll stop here by saying that we are probably one of the best positioned in the world by various structural, for various structural reasons, but it will still be a challenge. We are not out of the challenge zone.
Yeah, I completely agree with you, Deepak. Now the world is so interconnected that though India has much lower exposure to the US export market, nevertheless, we would also get indirectly impacted. But yes, the impact is going to be much more than many other economies. And in fact, interestingly, Vietnam and Mexico that have high exposure to US market, these are the two economies that had benefited during the first trade war, because they managed to increase their export share to US. But yes, now they would also feel the pinch of this global turbulence. And I'm not even sure if US is going to benefit from this. So yeah, net, all the economies are going to suffer. With this, I'll move to Sanusha. We spoke about trade, and Sanusha, there's also going to be huge impact of all this on FDI. Like we showed in our presentation already. If you look at FDI to GDP globally, it has been going down. So going forward, how do you see global FDI flows are going to pan out, and what do you think will be the implication of all this on African economies? Because many of these economies have huge dependence on FDI for their infrastructure requirement also. So in that sense, how do you see the African economies coping with these developments?
Good afternoon, and thank you very much, Rajani, and to my colleagues, and the discussion really sets a very important tone. I think in the case of Africa, or in more general terms, and speaking about FDI, we know that FDI flows is contingent on what is happening in terms of the structural conditions in the global economy. And of course, the reports that have cited a decline in terms of global trade, the revising of GDP growth, etc., all impacts on the flows of FDI. So do countries have enough money to invest in other countries? And more importantly, I think you can't see FDI in a vacuum. You've got to see it as part of the symbiotic relationship FDI has with trade. So we can't ignore the impact that what we have discussed and described and characterized as the kind of global trading architecture that's going through these existential risks and systemic risks around what was being really put out in a very cohesive way in the presentation around the push and pull factors. When it comes to FDI, I think what we are seeing in this context is, again, how FDI is also following not just some of these tightening or the tensions around the trade, and we spoke about a little bit, we touched on the tariffs, we spoke about the export growth level model, we spoke about consumption, and we spoke about debt, but it's also linked to issues in terms of what are some of the key dynamics that FDI will be flowing. So in terms of the World Investment Report in 2024, you could see that in 2023, FDI declined. But again, it's not just about the decline. And I think we need to be careful in just characterizing FDI trends and patterns in terms of decline. We've got to look at where these trends and patterns are showing decline, but where are they also showing a kind of positive outlook in terms of where is some of this FDI going, or where will it be going? So I think what we're really seeing is fragmentation around the FDI flows, and also it's being regionalized. And I think Tanu mentioned a bit of this in terms of the regional trade agreements, and it's linked to regionalization. And more importantly, I think in the current architecture of the global economy, it's linked to specific sectors or sectorial shifts. So things like green energy, digital infrastructure, but most importantly, I think FDI flowing in terms of critical minerals. And this is where I think the geopolitical issues around FDI flows is also very important to understand or unpack, because it does have an impact in terms of, are we going to see, for example, in Africa, the big resource investments in, say, infrastructure, but infrastructure linked to what? And I think infrastructure linked to things like the critical minerals. And so in this context of critical minerals, this is where some of these resource-orientated investments are very much enclave investments that are taking place. And they're also taking place in countries with sometimes not very good or weak governance systems in terms of the kinds of bilateral trade agreements that are happening, the kinds of non-disclosure clauses that are in these trade agreements, but also in terms of how much this investment will be recouped in terms of the return on the investment. So in the case of critical minerals, and what we've seen recently in the African context, some of the sectorial shifts with regard to particular countries or particular regions. We're looking at, for example, the DRC and how that is around the critical minerals, or that the Trump presidency had this mini summit of 5 African countries, very specific around some of the commercial diplomacy and how that is to link up to the FDI. So in that kind of context, I think that the FDI is becoming more and more aligned to the geopolitical issues around the international system, but also in terms of, are we seeing some of this bilateral engagements around trade that's then flowing into the FDI? And so FDI is very specific in where it is being identified as a key kind of driver in terms of backing up the trade engagements and so forth. So issues around, are we moving from a more global context to a more kind of specific set of interests that are linked to FDI in terms of some of the sectors that I've mentioned. Again, I think on a broader scale, investors are very key and very clear about where they want to invest. And so there is a level of whether we are seeing more risk sensitivities that are coming into this engagement around FDI. We noted countries that may have weak governance systems, but that also opens up a difficult scenario for how do you enforce regulatory rules. And how do we actually think about regulatory rules when it comes to these risk sensitivities around long-term attraction of FDI? But the one thing that we have to also think about is, and this is becoming quite critical as South Africa is coming towards the tail end of its G20 presidency, and that is this issue around climate change. And what we are hearing is that if with the US taking on the presidency of the G20 at the end of this year and for next year, that they may actually want to move away from some of these issues around climate justice, climate transition, climate investment, and so forth. And that could have long-term impacts and impacts about where investment in terms of green technology, what kind of technology we're talking about, what kind of green infrastructure investment we're talking about, or is it going to be really much more linked back to how does the US then or other countries benefit out of infrastructure, green financing, but not necessarily for the just energy transition. And that is a point that we need to bear consciousness on. Implications for Africa, I think, is very important in the sense that we are going to see greater competition, if not already, around the attraction of FDI, bearing in mind that Africa is a very heterogeneous continent. There's no set of saying that there's a one-size-fits-all approach to the African context when it comes to the FDI and attraction. And we're seeing this happen from a kind of geopolitical architecture. We're seeing that, for example, the issue around the securitization of the critical mineral sector is really linked back to peace and security, but linked back to access and securing access to the critical minerals, partly because of the competition with China, but also with that. And then, of course, we're going to have dependency on resource-based FDI. And then, of course, there's going to be questions of FDI concentration and risk of FDI concentration. And this is going to be critical in terms of how does it actually boost the kind of export or the kind of economic model that we want to create in terms of development for Africa. So it's a bit of a game changer right now.
Yeah, completely agree with you, Sanusha. So, Thilan, I'll come to you with that. So, we spoke about, trade slowing down. We spoke about FDI slowing down, and a lot of emerging economies. We spoke about, economies like Vietnam, Malaysia, Thailand. They have high export to GDP ratio. They have very high FDI to GDP ratio. So, what would you suggest? What should be the strategy of emerging economies to maneuver this change that's happening? If we are going to have lower trade flows, lower investment inflows, what should be the strategy of emerging economies?
Again, thank you very much, CareEdge, for inviting me for this very interesting and timely webinar. Thank you for the question. I'm going to wear my hat as the former chairman of the Board of Investment when I, as a young investment banker some 20-some years ago, was hired by the government to head up Sri Lanka's premier export and investment promotion agency. I think the critical aspect of emerging economies in diversifying its reliance on the US market is obviously to diversify its export basket and obviously engage in trade and investment partnerships with other countries. Now, countries such as Vietnam was so heavily, and I think to some extent Bangladesh as well, and Sri Lanka. In the case of Sri Lanka, we are about 6% or 5 to 6% of GDP exports to the US. And if we take our apparel sector, which accounts for about 40% of exports, 45% of that apparel exports to the global markets is exposed to the US. I think the importance is diversification from exports to a great degree into services as well is going to be important. Now, if I were to go back to the scenario of Sri Lanka, where we had challenges in the late 90s and early 2000s with a conflict going on in the country, the focus there was that we would focus on the country's competitiveness and attract sort of investment that would build a base for export diversification, and that includes focusing on the port of Colombo. Sri Lanka at that time had all of its terminals being operated by the government-owned Sri Lanka Ports Authority. And I led the government's negotiating team in the late 1990s, and we financially closed Sri Lanka's first ever private port terminal for the whole of South Asia. And in fact, Sri Lanka's port terminal, PPP, was used as a template for the rest of South Asia. And that resulted in the efficiency of the port increasing by 60% and ship waiting time by 85%, and established Sri Lanka as a transshipment hub, and therefore diversifying our export basket more towards services. And consequently, we went from exports as a percentage of services being around 40% to 65%, along with the growth in other services sectors such as ICT. I think the way in which emerging economies can meet these challenges is to focus on services such as ICT. I can again go back to the case of India, but in the case of Sri Lanka, it had a much more dramatic impact where the government, with the privatization of telecoms in the late 1990s, and the resultant dropping in costs of data and building ICT infrastructure and encouraging private universities, we had a situation where ICT exports grew by double digits, around 15% per annum compound over the next 15 to 20 years. And of course, the other aspect is tourism, particularly in Sri Lanka after the end of the conflict in 2009. The investments in tourism have grown significantly, and so have the numbers. I believe this year Sri Lanka is going to hit an all-time high in tourist arrivals, and going back to pre-pandemic, pre-Easter attack levels being exceeded. So again, to come back to your question, I think the important aspect is diversification of your export basket, that focus on services. Entering into additional trade agreements would be the way forward, in my view.
So diversification is the mantra, to put it in a nutshell.
Yes.
So with that, I'll go back to Tanu. Tanu, if we look at FTAs, now the future FTAs are going to look beyond tariffs. So, the expectation is that going forward, the FTAs are going to focus on services trade, they'll be focused on technology transfer, R&D, non-tariff barriers. So, in that context, what should we expect? What kind of FTAs should we expect going forward? And another aspect as to what is it with emerging economies? How should they ensure that when they lower the trade barrier, they don't get very adversely impacted? What should they be cautious of?
Yeah, again, a brilliant question, especially in the current context when India is amidst negotiating or signing a lot of comprehensive trade agreements. So, it's something which is these comprehensive nature of trade agreements is something which is not really new again. The first comprehensive one that we signed was in 2005 with Singapore. And before that, a lot of other countries were engaging in comprehensive, but for the benefit of the audience which is joined here, what is a comprehensive agreement? Anything that goes beyond tariff reduction to talk about other issues, as you said, trade and services, investments, government procurement, etc., etc. So, to be fair, we have been signing comprehensive agreements, but what we are seeing now is actually going beyond areas where there is multilateral jurisprudence. So, a lot of our previous comprehensive agreements have still included areas where multilateral jurisprudence existed. But now we are diving into areas where there is no established multilateral jurisprudence. And these includes areas such as trade-related aspects of labor and environment. Now, some of these aspects are covered through certain international treaties, but they are on best endeavor basis. These are often called WTO plus issues. On most of these issues, there are no specific rules that are already in place when they intersect with trade. Therefore, it becomes harder for trading partners to arrive at governing rules for these aspects in preferential agreements. Also, there's ambiguity on their implications, especially when countries that have domination of smaller enterprises. What happens when you intertwine industrial policy rules with trade rules? The implication you can only know ex post, not at the time of signing the trade agreements. So, a lot of the developing countries and emerging market economies at present do not have established, very well established comprehensive regulations on domestic policies on some of these issues. And hence what happens is that they are at the receiving end. So, Sanusha was mentioning about critical minerals and climate related issue. A similar issue that arrives in trade agreements is the carbon border adjustment mechanism, CBAM, where the European Union is the champion. And then these are used as negotiating chips by developed countries and for their trade partners. So what is it that developing countries have to be careful of? Well, one is what all are you including in the trade agreement? The other is how are you designing your how are you designing your trade agreement? What is the policy space that you're keeping? Whether these new rules are inserted in trade agreements on as hard laws or on best endeavor basis. So, these are some of the things that we have to be careful about. And, the beauty of a preferential arrangement is that it is inherently selective in nature. There is no one size fit all kind of mechanism that you have to follow. So you can actually have deals which are specifically crafted for specific trading partners. You can have systems, for instance, MFN forward, MFN binding, ratchet clauses, etc., to make sure that there's certain preferences that you're only giving to specific partners. And all of these systems, so now it's not just about what is covered in the trade agreement, so what are your commitment, but also how you are designing it. What is it which is coming in as a hard law, and what is it which is coming in on best endeavor basis. This also requires closer home. It also requires building better understanding on some of these new issues. So, when we are negotiating, we should negotiate with a more informed position. We have to inform ourselves about what are these new rules, what are these new dimensions which are coming into the trade agreements before we actually go out and negotiate. And stakeholder engagement, speaking with the academics and speaking with people who are actually in the thick of things, help you to build more sound trade agreements going forward.
Thank you, Tanu. So, Deepak, with that, very quickly, we would like to get some perspective on the currency market. So, like we discussed in the presentation, there has been a sharp weakening of US dollar. Now, what from here? What should we expect going forward? And if US dollar weakens further, if there's a further sharp weakening, what is going to be the implication of that for other economies, specifically emerging economies, in terms of trade flows and capital flows? And Deepak, I request you to keep your answer brief because we would also like to touch upon debt in this discussion, sovereign
Okay.
debt.
Okay, very good. So I think it is very clear that this is part of the overall program which the new U.S. administration has brought in, and this is exactly what Steve Mehra, the chief economic advisor to the new president, has said, that U.S. has carried a strengthening currency for a long time, which by definition means that other countries were allowed to weaken their currencies regularly. India is one of them, which benefited these countries to export more and benefited economically. And I think that is exactly the position that the US wants to reverse. Now, that's one part of the story. The other part of the story is dollar index has gyrated enormously in the past, from the peaks of 160 down to 75, up to 110 again after the COVID crisis, and now down to some 97 levels. The long-term average of dollar index is about 92. The last 25 years average is about 96, 97. So I think it has corrected down to its long-term averages. The weakening of the US dollar does not mean reducing the dominance of the US dollar. So these are two different concepts and should not be confused with each other. And clearly, the exporting countries to the US now not only just have the tariffs to worry about, they also have a strengthening currency, which is an additional tariff, in effect, to worry about. So yes, there is no country quite immune from it. But at the same time, US dollar may have hit its long-term averages and may have run its course in terms of weakening, but only time will tell.
So with that, we'll move to the third issue that we want to discuss. So we have very little time, so we'll have to do this quickly. But Sanusha, I would like to get your view on this whole issue of rising government debt. And the cost of capital is also relatively higher. So how do you see African economies faring in this situation?
Well, I think what's very important is that the rising debt is actually increasing rising debt interest repayments, which is then causing fiscal distress and other debt burdens, but more importantly, defaults and risks of default. And that sharply impacts on Africa's kind of domestic mobilization of finance in order to invest in their own socioeconomic programs and so forth. And it also can lead to reduced long-term infrastructure financing as well. So what we are seeing in a sense is that the cost of capital and the borrowing of money is actually quite negatively impacting on Africa. And it's actually creating a slowdown in terms of where Africa needs to be in terms of, if it wants to move away and diversify its export base, move towards service industry. It will also impact on the African Continental Free Trade Agreement, which is really about building and deepening intra-Africa trade. So this will undermine Africa's competitiveness, but also it will create more dependency on external actors and not necessarily just on what we're seeing with regard to whether it's the multilateral debt. It's also the private debt as well as bilateral debt, which can cause these severe impacts on Africa's ability to pay back its loans and cause serious dilemmas and dislocation on Africa's development in terms of its integration, its competitiveness, and of course its ability to be part of the global markets.
So with that, I'll come to you, Thilan. So if we look at the government debt for some of the emerging economies, we are also seeing increasing dependence on China for debt. So do you find this aspect concerning? How do you look at this whole dependence on China for debt?
Yes, it is certainly concerning, and Sri Lanka is the poster child for you to look at as a case study of the implications of that. Not so much because of the percentage of total foreign debt that came from China, but because of the quality of that debt and how that debt was utilized in what I would like to refer as white elephant projects that did not diversify economy towards greater investment multipliers or export orientation. So in Sri Lanka's case, it was only 10% of foreign debt that came from China. However, that debt was used to build a port, for example, in Hambantota that was not at all viable, and an airport and various other types of infrastructure, which forced the government eventually to privatize these again back to Chinese state-owned companies in order to lower the debt burden. And then we have a situation where even certain FDI projects that were made by state-owned Chinese companies in the form of, say, Colombo Port City, 12 years on, it has not given any return, and probably less than 10% of the land that was reclaimed from the sea next to Colombo's business district have been passed on to investors. So these have resulted in colossal failures commercially for the state-owned companies from China as well as the government because they have not provided the required returns. And so the challenge is in an era where the borrowing from international debt markets, 54% of Sri Lanka's debt came from international sovereign bonds, is going to be challenging. So the real crux of the situation is the action that Sri Lanka took in order to become debt sustainable. Apart from restructuring the debt, we passed several very important legislations in the form of public debt financial management acts and various other legal reforms in order to put the checks and balances where when debt is obtained, it goes through a rigorous process of evaluation to look at economic benefits, whether that particular debt would have any other form of opportunity costs. So I think the key aspect here is that governments need to be more rigorous in the way in which it borrows, and secondly, the government needs to look at diversifying, if not privatizing state-owned enterprises to pay down that debt. Now, that's what happened in the late 1990s when I was in government, where when telecom was privatized, that money was used to retire debt. And that's what governments, I think, need to be doing in the future.
Thank you, Thilan, and thank you to all the panelists for a very interesting and insightful discussion. We'll move to the Q&A session. We have very little time, but I'll see if we can take a couple of questions.
There's some questions which are posted in the Q&A box.
Yeah. So I'll just take some questions from here. So we have a question where the viewer is asking, with Donald Trump-led trade tariff rates, will Donald Trump-led trade tariff rates impact the repo rate action decision by US Fed as well as by the Reserve Bank of India? So, Deepak, can I request you to take up this question?
Yes, I think it's a very good question, and it's a moot subject. Even the Federal Reserve itself is not very clear how to look at the impact of tariffs on inflation. So we can already see on a month-on-month basis that inflation in the US has started creeping up, not to a very large extent, but it is. Now there is a division within the Federal Reserve whether to look at this inflation, which has come due to tariff, as a one-off price adjustment, or whether to worry about it as a persistent inflationary pressure. Because if it is a one-off price adjustment, then you can look through it and ignore it. But if you think that this is going to lead to persistent inflationary pressures, then you may need to keep the interest rates higher for longer. Now, that's the big debate which is going on in the FOMC, and there is no clarity as of now.
Okay. I think the next question on debt. With top economies with higher debt to GDP, besides the cost too going up, how is the fear of default playing? This way, considering US 72% of government debt is held by normal US entities, isn't this risk very looming just in case some outside entity sells these papers? So, this is an open question. If any of you would like to take this.
What we are seeing in the last, from April onwards, since tariffs have been announced, and from January onwards, that the demand for US debt has not gone down. In fact, all the Treasury Department data is telling us that the bid to cover ratio, which tells you how much every Treasury issuance gets oversubscribed, that oversubscription level remains very high. The second thing that data is telling us that indirect buyers, which represent the foreigners, continue to be as high as ever. So this worry about US debt not being attractive anymore, or lack of demand for the US debt, is not showing up in the real data. There is no other debt market in the world that can take the liquidity, that has the depth, that has the liquidity and the size. So it remains the ultimate safe haven. There's no change to it so far.
Deepak, actually, there's another question for you. The viewer is asking, you mentioned China is closed on FTA outcomes happening in future, but the statements in public domain show positive signs of good trade agreement between USA and China. Your inputs on this, please. What can we expect in the future from that signing of documents? Which country will eventually benefit?
Look, China and US are joined together. It's a synergistic marriage of convenience. China provides $500 billion of goods to the US. US is the biggest importer with $3.3 trillion of imports. China cannot live without the US. US cannot live without China. Both also have other stuff like critical minerals that China has and technology that US has. So this is a marriage of convenience. Whatever happens in the public domain is something that we shouldn't worry about. They will find a place to negotiate and settle with each other. And what US doesn't want is to use other countries as transshipment locations to avoid tariffs that China would have to pay. Case in point is when Vietnam deal was signed, Vietnam's tariff rate is 20%, but transshipment tariff rate is 40%. So that is to dissuade China from sending goods from other countries. But China and US both can't live without each other.
There's one more question. This will be the last question we'll take up. With USA tariff coming in and India's increasing inflation, what are your thoughts on India's GDP? Will India be able to achieve its projected GDP?
Can I answer this?
Sure.
Okay, sorry. So, sorry, I don't want to answer all the questions, so that's fine. Yeah, I think it'll depend how our trade agreement with the US looks like. if we have to reduce tariff rates on US imports, the tariffs that we impose on the US, which are massive, 50 to 70%, if by any chance India was to remove those tariffs, just like Indonesia and Vietnam have done, then it will be a very big blow to our manufacturing sector, because US goods can then flood the Indian markets. We love the US goods. By the way, the iPhone sales are bigger than the sales of all of Hindustan Lever's complete total sales of India. iPhone sales is more than that. So that's how much we love the US product. So if we lower our tariffs to the US goods, US vehicles, US food, US agriculture products, they will flood and they will destroy our industry here. So it all depends upon the government now. How does it negotiate? And that's why I said it's a very, very tough negotiation. It can have direct impact on our GDP.
Sure. And I'll just add a little bit to that. In fact, for India, we are expecting a moderation in growth, but we are still expecting a healthy growth of around 6.4% for FY26, which is very good in midst of all that's happening around us. So I think on that note, I will end this panel discussion. We have just crossed our time by 5 minutes or so. But yes, thank you very much. A very interesting discussion indeed. And over to you, Mamta.
Thank you, Rajani, for moderating the session, and Akanksha and Annie for your presentation. Once again, we thank all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at the feedback mail. Goodbye for now, requesting the tech team to kindly log off. Thank you.
Thank